Hello, hello. Welcome to another episode of Financial Tides. I'm your host today, Taylor Perillo, Certified Financial Planner. And today we're going to be talking about whether or not it's the time to refinance. So I'm sure everyone is following rates and mortgage rates out there and see that they have started to move down a little bit. And I saw that there was a headline saying that the volume of refinances has just spiked 60% above what it was. So it seems like people are rushing in to get those refinances done. So I figured we would talk about it and whether or not it's the time now to refinance or not. So for some people, this can mean it saves tens of thousands of dollars over the life of the loan with a lower interest rate, giving yourself the opportunity to pay off the home years earlier, or even freeing up some cash flow, or in the case of a cash out refinance, giving some additional funds to roll into a different project. So we're going to talk about whether it's a costly mistake for you or you have one of those benefits and where some of those situations are that we could see that. So, high level, what does refinancing mean? I'm sure most are familiar with it, so we'll go quickly through this. But refinancing is really just replacing your old loan with a new one. And the reason to do that is typically better terms or something that makes more sense for you and your situation. So this is most commonly used for mortgages, which is what we're really going to be focusing on today. But it could also apply to student loans, auto loans, or even some credit cards through a balance transfer. So an example is if you bought your house 2019. I know this isn't what the interest rates were back then, but we'll just use it as an example. Let's just say you bought your house, you got a 6% mortgage rate. Rates now theoretically go down to 5%. You would want to possibly refinance your loan now a full percent lower so that you have a cheaper interest rate payment and possibly save some money. So that's kind of the high level, but why would people refinance? So the first reason people would refinance would be a lower interest rate. So this is the number one reason people typically refinance. It's why we're looking at rates now and seeing how they're moving. So even as low as a half a point of interest can mean thousands saved over time, specifically for people that are at the early end of their mortgage where they're paying mostly interest. This makes a lot of sense. The smaller moves can make a big difference. The next is to lower the monthly payments. So a lot of times you can extend out your term. So say your 30-year mortgage, you pay 5 years of it, and now 5 years later it's time to refinance. You've already paid a big chunk of the loan, or not necessarily a huge chunk, but you paid a chunk of the loan. So stretching that back out to 30 years again can reduce the monthly strain if you're struggling, if you took a different job or have a different income situation and cash flow is tight, or if you're expecting major life changes, say childcare. You now have a kid and a family, and you need some additional funds. You can extend the loan back out and maybe free up a couple $100 to help pay for childcare each month. Another reason to do it would be a faster payoff. So, say your cash flow situation has changed from when you originally started. Instead of having student loans or credit card bills and other things that you were paying back in the day when you took on the mortgage, you now have a higher paying job and no other debt, and you can make extra payments towards the loan. And you want to switch to 15 years instead of 30 years. So it could make a really big difference. So one of the examples is a $250,000 mortgage at 6% for 30 years is going to cost you about $289,000 in mortgage. So, or in interest, sorry. You're going to pay more in interest than you actually pay in principal over the course of the loan. So some people would say, well, I don't want to do that. 30 years, though, gives you the flexibility to make the payments you want. You can always pay extra. But on the flip side of that, if you know you're going to pay extra and you have no issues continuing to pay extra, you can refinance it to a 15-year mortgage and you're only going to pay about 129,000. So that's a huge difference. You're paying about half of what you would pay in the principal payments and interest in a 15-year compared to what you would pay in a 30-year. So that's a very big difference. It's why people switch sometimes. You don't have to switch just for this reason. You can pay extra principal only payments and accomplish something largely the same, but it's something to think about if you are thinking about refinancing at a lower rate, that you can do that and get the cheaper pay or the quicker payment schedule if you're going to be switching loan types anyway. Switching loan types is another reason. So you see this a lot, and it's not as common as it was when rates were low because no one wanted to get adjustable rate mortgages when rates were low because why not lock in a fixed rate? When rates started going up, adjustable rates became common again because people wanted the opportunity for their rate to come down while rates were coming down. So, what happens with adjustable rates is there's a certain period of time, typically at the front end, where the loan is not yet adjustable. So a lot of people may be coming out of that period now where they had a 2% or a 3% mortgage to start, and then it started adjusting and going upwards. And now, if their adjustment period is over, they may be paying 6 or 7% mortgage rates, and it makes it hard to afford that payment. So if that's the case for some people, they would want to switch possibly to a fixed rate and maybe get instead of the 7% adjustable that they have, get a 6% fixed rate and lock in, have stability, know what their rate's going to be long term. So same common thing. We'll just touch on student loans and other federal private loans. You can get a lower rate similarly and switch the loan types by going to instead of a private loan, some other type of loan that would be possibly cheaper. And then another one, just debt consolidation. So this is the mortgage cash out refinance that I'm talking about. So if you have other big forms of debt with high interest rates, whether that be credit card debt, HELOCs, other forms, you could refinance to cover and pay off some of that by taking cash out of the home equity that you have. So you would replace it with a larger loan. You'd pay down the debt using some of the money that comes out of the home equity, and then you would hopefully have a lower interest rate on the debt that's in the mortgage, rather being it's collateralized, rather than say on a credit card that might be 25% interest. So why the timing matters now. So I think that this is the main reason we're having this conversation is because in the news we saw that the Fed has announced that there would be a rate cut in September, which has now happened. Mortgage rates did kind of creep down right before that rate cut happened, just kind of forecasting that we would have one. But they're talking about two additional rate cuts this year and possibly a couple more in the following year. So this is why we're talking about it now, because when I saw in the news that refinances had spiked 60%, the first thing that came to my mind is this too early? Are people doing this too soon on the news of the first rate cut and not being patient enough? Are rates going to come down more in the mortgage market? And when will that really happen? And when's the ideal time to do it? So we don't have a crystal ball. We don't have any right answers, but knowing that the mortgage rates are kind of influenced by the bond market and the expectation of what the Fed is doing, I think it's really important for trying to kind of take an educated guess and forecast of what you should do when it comes to rates specifically. So, question, lock in today or waiting? So, that's a trade off. Like everything else, it's a trade off. If you refinance now, you're securing certainty, but you might miss out on a lower rate later. That's okay. You could always refinance again. The problem is you don't want to continue to pay closing costs on new mortgages, which can add up and really eliminate a lot of the savings that you have. So, in my opinion, I think that the time to refinance goes to a couple different factors. So, rates lower than your current loan. That's an obvious one. You don't want to refinance at a higher rate if you don't have to. Are you going to stay in the home long enough to benefit? If you're already making extra payments on your loan, you may not need to do any of the refinancing at a lower rate because you might pay off the loan quicker than the interest would be that you would save over time. So there's a couple factors that go into that. The other one is financial profile improving. So having more assets and more money to it that you might even get a lower rate just based on your credit rating or anything like that. And then aligning the loan structure with kind of your goals in life. So that's really important because if you say, hey, I want to make sure that before I retire, I have my mortgage paid off because I don't have quite as many assets that I would like to have to make sure that I can cover myself in retirement. So I need to lower my expenses. You may want to pick a loan structure that helps you accelerate the payoff of that loan. So when does refinancing not really make sense? Um, Big one is really the fees and the closing costs. So if those are going to wipe out your savings and you're going to have to keep refinancing to get lower and lower, it might not make sense to keep doing that. It might make sense to wait and be patient and try to see if there's a lower rate. Interest rates tend to move ahead, or the mortgage rates tend to move a little bit ahead of the actual Fed rate cuts. So there might be some of the future rate cuts already priced into the current mortgage rates, but I don't think rates are quite at their bottom yet. I think there will be more time to refinance next year at even lower rates. So I think a lot of what I'm seeing now is that, and this is still a guess, but that it makes sense to wait a little bit longer, perhaps into next year, to see where rates are going and how many additional rate cuts we're getting. The other reasons why it doesn't is because it resets your clock and your debt, so it could hurt your long-term goals. So, for example, if you're going from 20 years left on your mortgage payment, and you're saying, "Wow, look at all these savings I'm going to have. I'm going to have such a lower payment." But you do it and it extends your clock back to 30 years instead of 20 years, it could hurt some of your longer term goals, perhaps retirement, for example, if you weren't planning on having that mortgage payment in retirement. If you lose valuable protections, so in the case of student loans, sometimes if you refinance, you'll lose possibly the availability of forgiveness of some sort. If it was a federal loan that had a plan that if you worked in the government or in some sort of service industry, specific one that I know about is like a veterinarian, you might lose the protection that you had that you can have forgiveness down the road or some protections as far as forbearance programs if you can't pay or income-based repayment plans. So I think it's important to take that into account too, is just make sure you're not giving up something with that loan to get a new loan. If debt consolidation is something that tempts you to spend more, I think this is the classic one of do not refinance just to eliminate your debt so you can start spending more again. So that's the case where people say, hey, I have a big credit card bill. I'm starting to get maxed out. They use the home equity and then they say, now I have a clean slate. I have no credit card debt. And then they start working towards maxing out that credit card again. So that is never a reason to refinance. You're just temporarily fixing a problem that's going to be a problem again. I have no problem doing it, but you have to fix the spending issue as well if that's the case. So deciding on when the right time is. So this is where we come in. We can help. We can run the numbers. We could factor in what your closing costs are. It costs you nothing to go to a mortgage officer, and we have mortgage officers we can recommend as well to speak with you about what it would look like, what the closing costs would be, what your new payment would be. So let's gather that information. Let's look at it and let's weigh it against your long-term goals, your protections, your savings, and see if it fits in with the broader financial strategy specific to you. So, in conclusion, refinancing isn't about chasing the lower rates. It's about shaping your debt in a way that supports your lifestyle, not the other way around. So, switching loan types and giving yourself more stability or more flexibility, simplifying your life or even lowering your payments, work in the big picture. They all come with trade-offs. They all need to be weighed carefully. And the key is to find a loan that works for you and not lock yourself into something that works against your goals. And we're here to help. We're happy to help with that. Feel free to give us a call after getting some information from your loan officer, or come to us and we can recommend a loan officer as well to help you run the numbers. Thanks for watching this episode of Financial Tides. Until next time.